6th of March 2023, Monday, MAO with Kel once again, right? Credit default swaps is climbing, okay guys? I know that not many people is covering this right now, and of course it's because I always look for new stuff to share with you, and I'm telling you guys this is getting serious. You need to pay attention to details later on. And if you remember what Janet Yellen says back in January, she says that if the Treasury Department don't get any answers from the Congress by June this year, they may face big problem. That's why I say that if this combined with the credit default swap problem, things can get very scary. So let's begin. Now, disclaimer apply as usual. Make sure you do your risk assessment, and thank you AIMS for the kind sponsorship. Now let's discuss what happened last night, which is last Friday first, okay? Now, first of all, we must understand this. Yesterday, on last Friday, the Dow went up by 387 points, the Nasdaq up by 245 points, and of course, incredibly, the S&P up by 64 points. Now, that is a big jump right here itself. This is something that really kind of unexpected, guys. We should understand that. So, the thing is this, okay? The thing is this is very important. Okay, just give me a moment on this technical site. Okay, that the Meta went up by 6.14%. Wow, that's a great jump here right up. All right, so the thing is this, what happened, all right, what leads to this is because the 10-year yield actually dropped below the 4% mark. So let's take a look. Okay, the stock market closed higher on Friday as Dow breaks the 4-week losing streak as 10-year yields retreat. Now, retreats is just very normal because it's just like everything can go up, there will be some profit taking. But you cannot deny that this 10-year yield will go higher beyond the current 4% mark. I believe that it will go to 5%, and that is where things will get very scary. And that's the reason why I still think that you should be very careful. So of course, again, profit taking expected. So what happened? The 10-year yield dipped below 4%, and that is because people are all worried about the current mortgage rates, the car loans. So if the rates is high, it's bad for people. And of course, now when they pull back, people just straight away jump in as an excuse to cover their short position and go long a little bit, because now the market is very sensitive to the bond yield price right now. And of course, after 3 weeks of downside market, 4 weeks, sorry, or losing streak, of course, a technical rebound for the week is kind of expected too. So that is the real reason why. As you can see, once the market opened on Friday, the market just went all the way up, no holding back. Every pullback, they just buy up, pullback, they buy up, and it closed near the high. Now, in a downtrend market, if the market closes at the high, traders should be careful because usually that could be a turning sign, a warning sign that could be profit taking the next few days. Okay, and of course, we all know that Michael Hunter from Bank of America says that the S&P will drop to 3,800 by Wednesday, the 8th of March. And where we are right now, we are trading at 14045. So we're talking about quite a far-fetched, right? Because this Michael Harnett says that it's looking at 3,800, and where we are right now is at 4045. So which means that we're about 245 points away. And if that is to happen, the Dow Jones must drop at least 1,600 points. Well, do you think so? That is where a big question mark comes in. Yeah. Okay. All right, so before we go into today's segment, that's all right, I want to take this opportunity once again to tell everyone of you thank you for all the support. Now we have about 800 plus people subscribed to my channel. That's good. And of course, last week we did the spin the wheel lunch with Cal, and 2 weeks ago, sorry. And we have 5 lucky winners to join me for the amazing lunch at this Haker at this Tan Kui Lan. So this week we'll still have it. So this week from today until Friday, in any of my video, leave a comment that is related to the market or the video. We will pick your name up, and this coming Saturday we will do another round, right, to have another lunch with me next Wednesday. Okay, so continue to leave a comment. You can leave as many as possible, but it has to be market related. Yep. Okay, thank you very much. Let's continue. Okay, so the ISM PPI data, PMI data, not PPI, my bad. Yeah, I'm going to change this for you immediately right now. The PMI data, okay, apparently came out better than expected. Okay, so this is something that caught my attention because why? It is not supposed to be higher. It's supposed to be lower, but it came out higher. So because of that, right, the market feel that, hey, not bad. That means that even though we have inflation, even though that we have a bit of economy coming down, but seemingly all is good. And of course, at the same time, you remember Bostic, right? also came in and changed his view from actually a very hawkish view to the bit of dovish as of Friday. So all this thing tells me that something is just wrong. Why would they suddenly do so many positive things out of nowhere, right? So that's where I began to dig into this, and I watched one YouTuber and she covered it very well. So I want to share this with you together, all right? So apparently this is the thing here. The United States of America now, the 5-year CDS, okay, the credit default swap, is now trading at 35.04. Now, of course, you may say, what is 35.04? It's a very low number, is it? Well, this is the latest update as of 3rd of March. Now, this is the value right now, okay? And it reveals that it's a 0.58% implied probability of default on a 40% recovery rate. Okay, now you may say that, what the hell is this, right? 0.58%, what's a big deal? Okay, I understand. But if you look at it now with the chart, it's a different story. Now, you can look at it here right now. We are now at the highest level since before pandemic, okay? And this is not a good sign. This shows that it's climbing, and it will go even higher if the things people feel that there's a risk factor right now. So of course you may ask, what is CDS first to begin with, right? Not everybody understands this. So don't worry, let's go. So CDS is a derivative product which serves as a form of insurance against the default of an underlying borrower or debt instrument. So basically it's like insurance, right, within 3 parties, okay? So when you do that itself, right, is to basically hope that the person who basically took the loan will not default, okay? But of course, if they default, right, then the one who actually create this CDS will pay the difference. So of course, this is something telling you that, right, they are trying to make sure that everything goes well, but in case you want to buy insurance, you go through this CDS, okay? So we saw it before in Lehman Brothers time, and the numbers is like picking up once again. So I want to let you bring to this Warren Buffett when he was being asked years ago regarding what he feel about CDS, and of course that's where I get very concerned right now. Let me bring it to Warren Buffett. Okay, let's go, Warren.
Should exist. They should be outlawed. What should happen to them?
Well, they can be a very destructive instrument. I mean, if you think about it, you can't go out and insure my house against fire because you do not have an insurable interest, as they call it in the trade. Because once you insure my house against fire, and you may decide that, you know, that maybe dropping a few matches around my lawn might be a good idea. And credit default swaps, if you don't own underlying debt and you buy a credit default swap, you have an interest in that place getting into trouble. And when a lot of people have an interest in a place getting in trouble, they may start putting out misleading statements about it. I mean, if you had a bank, if you were short the stock of a bank, you might hire, and there wasn't any FDIC, you might go out and hire 100 movie extras to stand in front of that bank. And in effect, you would create your own reality. Now, buying credit default swaps and talking about them and causing the price of credit default swaps to go up creates its own reality to some degree. So I think they are potentially a very antisocial instrument.
Okay, you heard that. That is a very, very, very important statement from this this Warren Buffett, because it actually says that, right, it's like if you actually have this in mind, then of course there's a rational reason. So if you look back again onto this right now, okay, that means that, right, by increasing on this CDS right now, seems that somehow some people are getting very worried on what's happening, and of course this will actually spill over to create unnecessary attention to it, and things may get terrible. So that's the reason why I'm sharing this right now. Seemingly somebody or some entity knows that the next few months things may get very drastic, okay? So of course you may say, but Kel, the thing is this, for the CDS or US who have a problem, it's not bit difficult because at the moment now, the 10-year to 2-year bond spread is at minus 89.2. Yes, it's really very inverted, so that's a main concern right now. But don't forget, US credit rating is at AA+, so it's pretty good, right? Yes, indeed. So the thing is that if this number, if central bank number continue to go higher, this spread will also continue to go higher in negative, then of course that will actually increase this, and that will increase the chance of a potential recession, okay? So this is where I'm warning everybody that to be very, very careful, because CDS is not easy to move up. But once it's to move right, that means that somehow someone or some entity is preparing for the worst. Now, if you look at it right now, the thing here, okay, you can see that, let me just bring my mouse. Okay, you can see right now, very important, This is the America liabilities and capital. Now, in short, the reserve in the treasuries, we have now about $381 billion. And of course, it's still okay. But if this figure goes down lower, we have a problem. And that's the reason why Yellen warns US default risk by early June, urging the debt limit to be raised up. Because if they don't do that, by June, they may expand their reserve. And of course, things will happen again. There'll be a lot of official closure and stuff like that. So that is the thing here. If June, they don't get what they want, and both sides of the Democrats and Republicans doesn't budge, then of course things will get very scary. And that's why I feel that by August, things will get even worse. And I'm still going to stick to my gun on this. I believe that by August, we will see the recession. Okay, so again, this will solidify what I view in the market. So traders, you must be very, very careful. So you look at the technical outlook right now, right, for the US Dow Jones is brilliant. The market came down, touched my 150-day moving average and rebounded. So by right now, because of this artificial propping up, because they don't want people to know the CDS problem, I believe they are purposely pushing the market up itself to just change attention. So the Dow Jones still will go back to 33,783 in the near term if the market continue to go higher. But watch it, guys. If the market lose 32,808, then selling is expected. Although we have a very strong moving average all here supported itself, right? Just take note, if the market loses that, selling will perceive, all right? Now, of course, on the other side, S&P 500 was brilliant. The S&P came down and touches the both MA 150 and 200 MA perfectly and rebounded right now. So, of course, the market is looking at 4,100 again. But as I said again, for this Michael Harner from Bank of America, seemingly he's confident to see 3,800 by Wednesday. So let's take a look what will happen. Now, if the market do lose 4,000, then maybe this thing can become a self-fulfilling prophecy. Yeah, that's for the S&P 500. And for the NASDAQ, you can see same thing again. The market came down to the 150-day and 200-day moving average precisely, and the market rebounded. So that means that for S&P, Dow Jones, NASDAQ, they actually take this 150 days to 200 days very seriously. So of course, if it's able to touch and rebound, it's positive. But if the market reiterate and came back down again and break the moving average, guys, things can get pretty bad, and the NASDAQ can fall all the way back to 11,000. Yeah, so again, traders, you need to think about all this. This is something not to be forgotten, because things can get very bad if things already happen. And of course, Meta, as I mentioned to you, Meta shares yesterday, so last Friday, gap up and trade higher. Now, what's happening? Now, when Meta was coming down, right, I was very, very bearish on this. I've been shorting this counter all the way. And of course, at about 85, I wanted to buy back. That was my target, but the market stopped at 89. And unfortunately, by 110, I was SWL out, means showing level kick out. But of course, the good part is that after that, the market went all the way up to sell to $150. Okay, so what is the thing here is what actually after that it gap out, sorry, to about 190. So what is the thing that basically make Meta doing so well, right? Is it because of earnings? Well, I beg to differ, because you look at earnings, right, it doesn't show you any relevant. In fact, the earnings shows that it's actually went down instead. The revenue itself, right, has went down. Everything has went down, so it's not good at all. So if not good, right, then why the share price is going higher? Well, one of the key reasons is because now the White House has imposed that there will be a TikTok ban for all the Federal Reserve devices. It means that all the officials are not able to use TikTok anymore. And that basically gave a lot of room for this Meta. And I think that the other reason is because that Meta actually announced a 40 billion stock buyback. That's a lot of money, and that causes the share price to jump up. But the thing is this, guys, you look at the volume is nowhere exciting other than last few days. So I just feel that, right, maybe we'll see about 190 at most. And then after that, the market realized that this is not going to work, and it may come back down again. And when it come back down, 150 should be the first target. Yep. So guys, this is how I view Meta. I don't think you should chase. You should be very, very careful on this. Okay. Now, the thing is this, as we all know now, more layoffs are coming in. Okay, guys. You can see right now, as of January 2022, last year, 283,000 people has been laid off. All right, most of them from US, some of them from the rest of the world. And of course, Amazon is one leading it, the charge of 18,000, and Alphabet and Meta not too far away. So the thing is, okay, if technology company down, I can understand, but how about bank shares? Okay, that is another big issue here. And I can tell you this, guys, if bank shares are not doing well, things can get very, very bad, because if the bank doesn't want to let out money because of self-protection, then of course things will get very ugly for anyone in the sector, right? So let's watch this, guys.
Every single trader that's taken the FTMO challenge using my mechanical trading rules has passed.
Yes,
Sally Bakewell on the phone, who helps lead our Wall Street coverage here at Bloomberg, with a little bit more detail as to what we know. Sally, how many jobs are we talking about here?
Yeah, so hi, Romain. So we're talking about hundreds of jobs across the company, with many from the Wall Street Giants investment banking division. Now, this is another indication, really, that the expense pressures that banks are facing, they're really leaving no one immune. Now, the size of job cuts across Wall Street, they varied very widely. Citigroup already eliminated dozens of staffers across its investment banking division in November, and then we had Morgan Stanley trimming a far larger number of employees, about 1,600 in December. And then along came Goldman Sachs, which embarked on one of its biggest rounds of reductions ever in January, cutting about 3,200 positions. But it all indicates that they are all susceptible to these pressures, and they're trying to pull that lever of headcount reductions to meet that.
The last time we saw something like this, guys, you remember, was back in Lehman Brothers' time, whereby the companies, the economy was seemingly doing well, and suddenly the company decided to cut people off, right, and laying off people. So when this all happened, right, it basically tells you that the bank is feeling it right now. So you must understand, when interest rate goes up itself, right, the economy at the start, after a low environment, will perform. But when it goes much higher, that's where, if the earnings are not able to meet the cost, that is where things will happen. And then after that, there will be a lot of delinquency, about default. And when all this happen, right, the banks will feel it first. They'll know that something is going to go wrong. They'll have to lay off people. And then, of course, they'll reduce their position in the stock market and other markets. And that's where you can see it's happening right now. So all I can say is that from BlackRock, okay, and Blackstone, all their performance recently, it just sent shivers down. And I think that, guys, you should be very, very careful, because things may get pretty wrong. Because you don't forget that Yellen has said already, the Treasury is taking extraordinary measurement to avoid default as US hit debt limit. And she already mentioned that, right, this figure is only to the bill to leave the country the 31.4 trillion debt limit, yeah, to go higher. So all this tells you that she has to get it done, and the time that she has right now isn't much. By June this year, she will need to get it soft, okay? So once again, all these tells you that this is not good, and you should be very careful, guys. You don't want to be caught on the wrong side of track. So now the thing is this, let's wait for, is it because the market is waiting for the hangover to start? Indeed, because now the composite leading indicator is now going below the usual par level, and the last time we saw this was back in the pandemic time, and next one was during the Lehman Brothers time. So to me, it's all right. All these leading indicators shows that the US economy is not doing well. And at the moment now, right, you can see that the Fed terminal rate is actually separating from the S&P, right? Originally, it was very close to one another. So now why is it so far away? Is that basically it's all waiting for things to explode, okay? So that is only happening when you drink too much, right? And you cannot, and you drink and you're drunk and you sleep, but next morning itself, you get one of the worst headache ever. It's something like that, okay? So at the start itself, everybody's okay, but now things have to change. If you don't realize it itself, the pain will be really, really bad, yeah? So guys, this is how I see it for the US economy, and I think that you should know what I'm trying to say, guys. Be careful, take care. I'll see you on the technical side. Cheers, guys. Have a great day. Bye-bye.